The investor's biggest problem and his worst enemy. The investor's chief problem and his worst enemy is likely to be himself. In the end, how your investments behave is much less important than how you behave. That quote was from Benjamin Graham, the same guy that was Warren Buffett's mentor. Look, what I'm going to talk about today isn't just new to you, but investment professionals such as my personal lawyer, who is one of the largest lawyers in the resource sector for some of the biggest companies in the sector. So please pay attention to what I'm going to talk about today. I spent the first 10 years of my career learning how to pick stocks. And even at that, I will continue to make mistakes. After hundreds of site visits and mistakes and successes on both the technical and financial side, I have found a framework that works for me. Almost as important as my due diligence framework is my framework on how I go about buying the stocks and when and how to sell. For one, you should never load up 100% of your desired position into any single buy order. Perhaps there are other fund managers and newsletter writers who have a mystic ability to buy only once and be set free. But I have found through direct experience that the best results have been from buying in tranches. Now, let me explain what tranches are. To keep things simple in my newsletter, I use 4 tranches for every company. Each tranche is 25% of my desired allocation, with specific price guidance for each tranche. In this scenario, 2 things can happen. If the stock takes off like a rocket, I have skin in the game. If the stock retreats to a level I deem discounted to its intrinsic value, and then I add to my position by taking my next tranche. No one can time a stock perfectly time and time again, so you have to ease into a position. Junior, mid-tier, and major stocks alike can have wild moves when a big player buys or sells a chunk of stock in the open market or in periods of market panics. If that happens, like in the market panic of March and April of 2020, an alligator investor, which we did in real time in our newsletter, can pick up shares of billion-dollar companies that run by world-class management teams that pay a fat and stable dividend for cheap. If the stock drops further, you can elect to pick up a second or third tranche to ease into filling out your entire position. For example, let's do a real-world example here. If you want to build a $10,000 position in a stock, consider splitting it up into 4 equal tranches of $2,500 each. Not all tranches may hit, and that's okay. Only a gambler or a novice investor goes all in. I learned that the hard way when I started too. For me, it makes sense to buy in tranches instead of timing and moving the stock price. This strategy has served me very well and allowed me to sleep soundly at night, knowing I never had to worry about timing the market. In mid-2017, I used this strategy firsthand to target research on and accumulate shares in a company called Nevsun Resources in my newsletter, in my fund, and personally. Nevsun was a base metals focused mining company that I was very familiar with. With a depressed copper price, the stock started taking a major hit. When copper started recovering, the stock did not follow suit. I began to buy my first tranche, my 25% of my desired position. And then my second tranche, and then my third tranche. Fast forward a little over a year, and the investment thesis hit on target. Lundin Mining tried to do a takeover bid, sending the price of Nevsun through the roof and to $5 a share. At that point, we locked in a Katusa free ride, another alligator investing strategy, so that we could take all the risk off the table and a free ride the remaining shares. A few months later, Chinese outfit Zijin Mining made a bid for Nevsun and acquired the gold company for about $6 a share. The chart is exactly the real time of what we did in our newsletter. The circles are exactly the buy. Now, what I want you to focus on is the first yellow circle, where in mid-2017, when I started buying my first tranche, my second and third tranches were actually at lower prices than my first tranche. It was a nice gain. Now look, it wasn't a 10-bagger, but a respectable win in a tough resource market. In total, we got 3 tranches filled for a solid triple-digit return. The strategy of buying in tranches also allowed me and my subscribers of the KRO To see gains in the portfolio of 130% in a world-class energy company, a 200% in a gold producer that we're now holding for free, this strategy isn't sexy. It doesn't sell thousands of books and seminars, but it works. Give your speculation some time to play out. Being patient and investing like an alligator, using my system of tranche buying is extremely difficult and requires discipline. And frankly, it's boring at times. It's fun loading up at once on a stock, but that's not how you score big in the resource sector. Over my nearly 20-year career, I've seen many people, including myself, become impatient and make irrational moves. As one of the largest financiers in the resource sector, I've made many mistakes, but I've learned from each mistake. I write it down and I explain them in detail in the newsletter. These are all lessons I share with my readers so that you hopefully don't have to learn the hard way. Being impatient has cost me a lot of money. And here's an example from personal experience. I met an analyst on a site visit in early 2006 and we bonded. He was a smart guy. Site visits do that all at times, especially when the plane is stranded in an unexpected 4-day snowstorm that no one was prepared for. We stayed in touch over the years, and Jed moved over from the firm he was at and joined Verde Potash. I believed in this individual, and without doing a site visit, I became one of his largest shareholders and purchased 4 million shares at 25 cents a share. Ironically, I bought the stock from a well-known money manager in the business. Now, I knew Jed Richardson really well. I knew of his strong technical background, and the company was trading at a discount to cash. So I was getting the management and the project for free. That is the opportunity that can happen in the resource sector. It was a cash box. The company had 29 cents cash per share, so I felt good about my $1 million bet. I had many meetings with the management, and then I planned to do a site visit of my own to the main asset in Brazil. Now, 2009 was a very crazy year for me, and as I spent over 300 days on the road and gained over 40 pounds as a result, and of bad habits such as drinking beer with geos at night on the road and not working out regularly. But you would be amazed how much market intel you can get from drunk geologists at midnight. Anyways, Verde Potash management laid out a specific time frame and business plan that they assured me they would hit if I stuck it through them, and I agreed I would. Well, the first milestone was delayed, then the second. And now remember, this is early 2009. It was a very rough market for the resource sector. I didn't have time to go to the project and see for myself. But a very close friend and a trusted geo of mine, thanks Miles Thompson, stated he knew the project and that it wouldn't work. I was skeptical after that and frustrated with management for missing their milestones. I lost sight of the main reasons I'd taken the position in the first place. Then the third milestone was missed, and I told them from day one, 3 strikes and you're out. So I sold the position. Now look, I still did well. I netted just under 100% gain. You would think a near double isn't bad in a very rough market. And that's true, but I screwed that one up. As it turned out, I missed an enormously greater score. Within 14 months, the stock was trading north of $10 a share. Now think about this. I paid 25 cents a share. Were the delays Jed and the management team's fault? No, it wasn't. The resource game has so many factors, from government regulations to all sorts of things. The reality was, it was my mistake. I was impatient. Even though nothing changed and I trusted management, I let one friend's perception of a project change my view. Specifically, my buddy Miles also had a project in Brazil. It's not Miles' fault either. He gave me his honest opinion. And Miles is a great guy and a very close friend of mine. I continue to learn from my own mistakes, and I try to learn from others I respect in the industry. I continually remind myself that if the specific reasons for investing in a company are still valid and I trust management, I shouldn't let non-management time delays sway me to abandon my position. Shit happens. We try to learn and better ourselves and hopefully become better investors. Now, I want you to think about something here. Now, granted, I almost made $1 million on that score, but I left $39 million on the table on the same company run by the same management team. And the only difference was 14 months. Now, big returns in waiting, the way of the alligator. I like to put my money to work as much as anyone else, and sometimes impatience can get the best of you. That's why I always recall the way of the alligator. If you're impatient and you're always doing something, you won't have the cash to buy up bargains during a crash. When you look at your cash positions as big returns and waiting, you'll start to realize how powerful the alligator buying system is after one or two big hits. Stay safe, stay well, and stay prepared.